Friends, thank you for being here today. What if I told you that the red candles you saw on your phone this morning were not a sign of a market crash, but rather a frantic signal of desperation from a financial system that is rapidly losing control? And what would you do if you realized the very weapon fired to destroy your spirit, the margin nuke, has ironically proven that the physical owners of silver have finally wrested the steering wheel from the paper speculators? To understand the gravity of the last 24 hours, we must first strip away the noise of the headlines and look directly into the engine room of the global commodities market. It is an old tactic, a cowardly tactic, but historically it has been a brutally effective one. Last night, while New York was enveloped in darkness and London was just pouring its first cup of coffee, the powers that be fired their most dangerous weapon. They didn't discover a new vein of silver. They didn't fix the broken global supply chain. They didn't announce a surplus of metal. Instead, they simply changed the rules of the game. If you woke up this morning, checked your portfolio, and felt that familiar pit in your stomach as silver smashed down from its highs, stop, breathe, because what you are witnessing is not a liquidation of value. It is a liquidation of leverage. The exchange, the entity that is theoretically supposed to be a neutral arbiter of price discovery, stepped in overnight and drastically raised the margin requirements for silver futures. They effectively made it 50% more expensive to hold a position than it was just hours prior. Their goal was precise and malicious: to force liquidation, to trigger a long squeeze, and to break the psychological spirit of the bulls before the weekend break. But here is the news they didn't expect, the data point that should terrify the bullion banks and delight every single person holding physical metal. It didn't work. In 2011, when they deployed this exact strategy, the price collapsed 30% in a week. In 1980, the price collapsed 50%. Today, the price flinched, it dipped, and then it stood its ground. In this comprehensive investigation, we are going to expose exactly what a margin nuke is, show you the historical playbook they are copying word for word from the 2011 crash, and prove that the smart money didn't sell the dip, they swallowed it whole. The banks fired their silver bullet, and the werewolf is still standing. Now, let's peel back the layers and examine the mechanics of this manipulation to understand exactly how the casino operates. To truly grasp why the market is red today, you have to understand the casino that we call the COMEX. Most people operate under the assumption that the price of silver is determined by two people swapping a coin for cash. It isn't. It is determined by speculators trading futures contracts paper, promises that legally claim to represent silver but are rarely converted into the real thing. These contracts are highly leveraged instruments. Until yesterday, if you wanted to control 5,000 ounces of silver, you didn't need the full $300,000 value of that metal. That ratio represents roughly 25-to-1 leverage. It is a double-edged sword that allows hedge funds, day traders, and high-frequency trading algorithms to bet massive amounts of money with very little cash down. This leverage is what allows the price to fly up during a rally, creating euphoric gains. But it is also the kill switch that the exchange controls. Here is exactly what happened last night. The CME Group issued a notice increasing that margin requirement. Let's say, for the sake of the math, they raised it from $12,000 to $18,000 per contract. That doesn't sound like much in isolation, does it? But imagine you are a hedge fund holding 1,000 contracts. Yesterday, you needed $12 million in cash on deposit to hold that trade. Today, at 2 a.m., the exchange taps you on the shoulder and says you now need $18 million. You have 1 hour to wire $6 million or we sell your position. Where do you get $6 million at 2 o'clock a.m.? You don't. So, the exchange's computer automatically sells your silver contracts at market price to cover the difference. This creates a wave of artificial selling. It is not because the fund wanted to sell. It is not because the fundamentals of silver changed. It is not because solar demand dried up. It is solely because the house changed the buy-in. This is the anatomy of a margin nuke. It is designed to flush out the weak hands, the speculators who are over-leveraged and undercapitalized. When they forced sell, the price drops. When the price drops, technical support levels break, triggering other people to panic and sell. It triggers a cascade. That was the plan. It is a mechanical flush of the system, designed to reset sentiment from greed to fear in a matter of hours. It is crucial that we place this event within its proper historical context by comparing the playbook of 2011 to the reality of 2025. They are running the exact same play today that they ran in May 2011. To understand the present, we must look at the past, because the banks are relying on your muscle memory of that trauma. I want to take you back to Sunday, May 1st, 2011. The world was chaotic. Osama bin Laden had just been killed, and the news cycle was saturated. Silver had just touched $49.50 in a parabolic vertical run. Everyone was euphoric. Then, under the cover of darkness, the CME Group announced a margin hike. They raised the maintenance margin by 13%. On Monday, silver dropped $5. The next day, they raised it again. On Wednesday, they raised it again. By the end of the week, they had raised margins 5 separate times in 9 days, hiking the cost of betting on silver by 84%. It destroyed the demand. It beat the market into submission. They forced the liquidation of billions of dollars of long positions. It worked perfectly. The price crashed from $49 to $33, and silver entered a bear market that lasted for years. Today, they looked at the breakout above $60. They looked at the empty vaults. They looked at the massive losses on Bank of America's books. And they pulled the same lever, raise margins. But this time, the result was different. Why? Because the market composition of 2025 is fundamentally different from 2011. In 2011, the rally was driven by paper demand, hedge funds buying futures contracts and retail investors buying SLV options. There was no shortage of physical metal in 2011. The vaults were full. So, when they killed the paper demand, the price collapsed because there was no physical floor. In 2025, the rally is driven by physical depletion. We have a 1.1 billion ounce deficit. The vaults are empty. Refineries are halted due to lack of ore. The people buying silver today aren't speculators using 25-to-1 leverage. They are industrial users and sovereign nations paying cash. Tesla does not buy silver on margin to build Cybertrucks. Samsung does not buy silver on margin to make electronics. The Indian government does not buy silver on margin to fill its strategic reserves. They buy with full payment. So when the exchange raises margins, the strong hands don't care. They don't get liquidated. This is why the price only dropped a few cents instead of a few dollars. The margin nuke only kills the paper speculators. It does nothing to the physical buyers. And today, the market proved that the physical buyers are now in control. You cannot bomb a physical shortage with paper regulations. But why did the price hold so firmly? The answer lies in the existence of a shadow order book and the formation of a massive bear trap. The fact that the market absorbed this blow today is the most bullish signal imaginable. It tells me that the paper market has become irrelevant. The physical market looked at the margin hike, shrugged, and kept buying. So, if the margin nuke failed to crash the market, what did it actually achieve? It created a classic bear trap. A bear trap is a technical pattern where the price is manipulated lower to trick traders into selling, only to aggressively reverse and trap them. Think about the psychology of the average retail trader today. He sees the news. Exchange raises margins. He sees the price dip below $64. He thinks the top is in. The government is stepping in. I better sell now and maybe short the market to make money on the way down. So Joe Trader sells his silver. Maybe he even places a short bet, betting it will go to $50. But who is on the other side of that trade? Who bought Joe's silver at $63.80? Was it another retail trader? No, retail traders panic on red days. It was an algorithm. It was an industrial buyer. It was a sovereign wealth fund. They sat there with their limit buy orders waiting for the margin nuke to shake the tree. They knew the weak hands would fall out, and they stood underneath with a bucket to catch the cheap shares. This is the shadow order book. In the stock market, you can see the level 2 data on your screen. In the physical commodities market, the real trades happen over the counter, OTC. They happen in private phone calls between massive corporations and bullion banks. Here is what is happening in the shadows right now. Corporate procurement managers at companies like Samsung, First Solar, and Tesla have standing orders. These are automated instructions given to their bullion banks. They look like this. If silver drops below $64, buy 1 million ounces immediately. Why do they have these orders? Because they are terrified of the price going to $100. They see the dip today not as a crash, but as a discount. They know the fundamental shortage is real. So when the CME raises margins and forces the paper speculators to sell, the industrial giants are sitting there saying, "Thank you. We will take that." This represents a massive transfer of ownership from weak hands to strong hands. A speculator buys silver to sell it next week for a profit. Samsung buys silver to melt it into a circuit board forever. Once Samsung buys it, that silver never comes back to the market. This is why the floor is rising. The float, the amount of silver available for trading, is shrinking every time there is a dip. The banks are accidentally helping the industry drain the vaults faster by creating artificial dips. They are allowing the whales to accumulate cheaper metal. I want to pause here and ask you a question, because this is the critical point. Do you believe the industrial buyers are strong enough to keep absorbing these hits from the banks? Or do you think the manipulators still have one more major crash left in their playbook? Let me know your thoughts in the comments below. I am genuinely curious to see where you stand on this battle. Since the margin nuke has failed, we must look ahead at the regulatory options left on the table and the potential for a great decoupling. So, the margin nuke failed. What does the exchange do next? They are running out of options. This is where the situation becomes perilous for the establishment. If raising margins doesn't stop the price rise, and if supply is truly halted, the regulators have only two cards left to play. Card number 1, position limits. They will announce that no single entity can hold more than X number of contracts. They will frame this as preventing corners and maintaining orderly markets, but the target will be the ETFs and the family offices that are hoarding metal. They will force them to sell down their positions, creating artificial selling pressure. Card number 2, liquidation-only mode. This is the nuclear winter option. They can declare that for the next 30 days, participants are only allowed to sell contracts. You cannot buy new ones. This effectively turns off the buy button. If nobody can buy, the price can only go down or sideways. If they do this, the paper price will crash. It might go to $50. It might go to $40 on paper. But here is the catch, and it is a fatal one for the exchange. If they turn off the buy button on the COMEX, the buyers don't disappear. They just move. They move to the Shanghai Gold Exchange. They move to the London over-the-counter market. They move to the physical dealer network. This will cause the great decoupling to accelerate. You will see COMEX silver trading at $40 because nobody can buy. And you will see physical silver trading at $90 because everybody wants it. The spread will be $50. This destroys the COMEX. If the COMEX price is $40 and real silver is $90, no miner will sell to the COMEX. Why would they? They will sell to Shanghai for $90. The COMEX vaults will drain to absolute zero in weeks. The exchange will become a zombie market, trading paper ghosts with no metal backing. So the regulators are trapped. If they leave the market alone, the price goes to $100. If they manipulate it too hard, they destroy the exchange and lose control of the global price entirely. They are damned if they do, and damned if they don't. This is why today's failure of the margin nuke is so critical. It shows they are losing the ability to influence the market without blowing up their own casino. Beyond the dry mechanics of exchange regulations, we must confront a darker, more consequential reality: the geopolitical arbitrage and the subsidization of the East. There is a layer to this story that goes beyond mere market mechanics, a layer that touches on the very heart of global geopolitical power. What the CME Group and the Western bullion banks fail to realize, or perhaps are willfully ignoring, is that by artificially suppressing the paper price of silver, they are committing a form of strategic suicide. They are effectively subsidizing the rise of their geopolitical adversaries. When the margin nuke forces the price of silver down on the COMEX, it puts a discount sticker on a critical strategic asset for the entire world to see. And who is the biggest buyer in the world right now? It is not the retail stacker in Ohio. It is the strategic reserve planner in Beijing, the sovereign wealth fund in Moscow, and the central bank in New Delhi. Consider the absurdity of the situation. The United States and its allies are currently engaged in a desperate race to secure the supply chains for the future green energy, advanced electronics, and next-generation military hardware. Every single one of these technologies requires silver. A Tomahawk missile requires silver. A solar panel requires silver. The satellites that guide our GPS systems require silver. It is not just money, it is a material of national security. Yet, by allowing the paper market to dictate a suppressed price, the West is allowing the East to drain its vaults for pennies on the dollar. This is the geopolitical arbitrage. China and the BRICS nations view these margin hikes not as a show of strength, but as a gift. They see the West panicking to save a failing fiat currency system by attacking the barometer of inflation, gold and silver. When the price dips because of a paper margin hike, the Shanghai Gold Exchange does not follow suit. Instead, the arbitrage window opens wide. Smart money buys the artificially cheap contracts in New York, takes physical delivery, and ships the metal east. They are exchanging inflated, printing press dollars for finite, strategic metal. They are trading a liability for an asset. This creates a paradox where the West is winning the paper war by keeping the price chart managed, but losing the physical war by bleeding its inventory. It is the equivalent of a store owner slashing prices to drive away customers, only to find that his competitor is buying his entire stock to resell it later at a massive profit. By the time the regulators in Washington and London wake up to the fact that their vaults are empty, the transfer of wealth will be complete. The East will hold the physical keys to the energy transition, and the West will hold a bag of worthless short contracts. Furthermore, this dynamic accelerates the death of the dollar standard. The BRICS nations are actively looking for alternatives to the US dollar for trade settlement. By proving that the Western pricing mechanism, the COMEX, is fraudulent and subject to arbitrary rule changes like overnight margin hikes, the West is destroying the credibility of its own financial infrastructure. Why would a miner in Mexico or Peru want to sell their silver based on a price discovered in New York when they know that price can be nuked at 2 a.m. by a committee of bankers? They will increasingly look to Shanghai, to Dubai, to Moscow for fair price discovery. This margin nuke, therefore, was not just a financial miscalculation. It was a geopolitical blunder of the highest order. It has deepened the resolve of the East to decouple from the West. It has accelerated the drainage of physical metal from Western vaults. And it has proven to the world that the only way the dollar system can survive is by cheating. The physical owners of silver are not just protecting their purchasing power. They are unknowingly participating in the largest transfer of strategic assets in history. We are watching the Gresham's law of geopolitics play out in real time. The bad money, paper derivatives, is driving the good money, physical silver, out of the West and into the hands of those who understand its true value. If you are finding value in this deep dive analysis and want to stay ahead of these market moves, please do me a favor. Hit that like button and make sure you are subscribed to the channel. It is the only way we can fight the algorithm and get this crucial information out to more people. This leads us directly to the immediate danger of the weekend risk and what I predict will happen on Monday. This brings us to the weekend risk. Why are the banks fighting so hard to keep the price down today specifically? Why Friday? Because they are terrified of the weekend. In a globalized market, the weekend is when the Western suppression turns off and the Eastern reality takes over. The COMEX closes on Friday afternoon. For 48 hours, the paper manipulators cannot touch the price, but the world doesn't stop. News happens, deals happen, and the Middle East and Asia markets open on Sunday night. If silver closes Friday at a new all-time high, it sends a signal to China and India that the West has lost control. It invites a massive gap up on the Sunday open. The banks know this. They are desperate to paint the tape. They want the weekly chart to look weak. They want a red candle or a long wick to signal exhaustion. They are trying to psychologically manage the sentiment going into the weekend break. But here is the danger for them. By keeping the price artificially suppressed today, By using the margin nuke to hold it down, they are effectively putting a sale sign on silver right before the Asian Open. China sees the margin hike. They know it's a sign of weakness in the Western financial system. Do you think China is scared of a CME margin hike? No, they view it as the West running out of metal and resorting to tricks. So Monday morning becomes a dangerous moment for the shorts. Based on the data, I want to make a prediction. Because the margin nuke failed to crash the price, and because the dip was bought up by industrial whales, the market is currently coiled like a spring. Short sellers who added to their positions today are now trapped. They are holding shorts at $63.50. The price is hovering above $64. They are already underwater. Over the weekend, the physical shortage stories will spread. The news about halted refineries will hit the mainstream. People will try to buy online and realize they can't. Panic will build for 48 hours while the markets are closed. When the Asian markets open on Sunday night and when the U.S. market opens on Monday morning, there will be a rush to get back in. The shorts will panic cover. The sideline money will chase. I believe we will see a gap up on Monday. We could open at $65 or $66. If we do, it leaves the shorts trapped below with no way to exit without driving the price even higher. This bear trap today was the necessary setup for the next explosive move. It shook out the weak hands. It consolidated the price, and it proved the floor is solid. The path to $70 and then $80 is clear. The banks fired their best shot, and they missed. In closing, we must discern the difference between the paper illusion presented to us and the physical reality we hold in our hands. Let's step back from the charts and talk about why we are here. Why are you holding silver? Are you holding it to make more dollars, or are you holding it because you know the dollar is broken? Today's action, the manipulation, the margin hikes, the volatility, it is all noise. It is the sound of a dying system thrashing around. The physical truth remains unchanged. Number 1, the geology. We are running out of mineable silver. Ore grades are falling globally. Number 2, the energy transition. We cannot build the future solar panels, EVs, electronics without silver. It is non-negotiable. Number 3, the debt. The global financial system is insolvent. They have to print currency to survive. When you hold physical silver in your hand, you hold a claim on the Earth's resources. When you hold a paper contract, you hold a claim on a bankrupt bank. The events of the last 24 hours are proof that the paper system is detaching from reality. A paper system is trying to say, silver is risky, sell. The physical reality is saying, silver is essential, buy. You have to decide which reality you live in. If you live in the paper reality, you are scared today. If you live in the physical reality, you are buying today. The margin nuke was a test. It was a test of your conviction. Did you panic? Did you sell? Or did you look at the price drop and smile, knowing that it's just a discount on real money? The banks are betting that you are weak. They are betting that you are impatient. They are betting that you will trade your hard asset for their paper promises. Do not give them the satisfaction. Friday, December 12, 2025, will be remembered not as the day the price crashed, but as the day the manipulation stopped working. We survived the margin nuke. We survived the empire striking back. If you are holding physical silver, go into this weekend with peace of mind. You own the asset that the world needs and cannot print. You own the asset that the banks are terrified of. Do not let the volatility of the electronic pricing system disturb your sleep. 1 ounce is still 1 ounce, and that ounce is becoming more valuable by the day, regardless of what the CME computer says. The game has changed. The old rules, where they could crash the price at will, are gone. The new rule is physical scarcity. And in a world of scarcity, he who holds the metal makes the rules. Enjoy your weekend. Ignore the FUD. Stay stacked. Stay strong. And I'll see you on the other side of the gap.